On Sunday, May 10th, Prime Minister Narendra Modi stood in front of a crowd in Hyderabad and said something that landed like a thunderclap in every Indian household. He said, "Do not buy gold jewelry for 1 year. Not a tax, not a policy, not a ban. A personal appeal. Directly to you, to your mother, to every family planning a wedding this season, to every person who has treated gold as the foundation of financial safety for their entire life." The jewelry stocks crashed on Monday. Titan fell 8%. Callian Jewelers fell 10%. Senco Gold fell nearly 12%. The Sensex dropped 1,313 points. The rupee hit a record low of 95.31 against the dollar, and within hours, every WhatsApp group in India had an opinion. Some said Modi is right. Some said the government has no business telling families what to buy for their weddings. Some said this is just politics. Some said this is an emergency that India is not fully acknowledging yet. Today, I want to cut through every one of those opinions and give you the real picture. What is actually happening to India's economy right now? Why gold specifically is at the center of it? Whether Modi's appeal makes any financial sense. And most importantly, what you, as a common Indian, should actually do with your money in this situation. This is going to be uncomfortable in places, but uncomfortable is better than uninformed. Let us go. Part 1. What is actually happening and why gold is part of it. Let me start with the root cause because without understanding this, nothing else makes sense. On February 28th, 2026, the United States and Israel launched military strikes on Iran. Within days, Iran closed the Strait of Hormuz. That single event disrupted 20% of the world's entire oil supply. Brent crude went from around $80 a barrel to over $120 a barrel in under a week. That is not a gradual rise. That is a shock. India imports approximately 85% of its crude oil. Every liter of petrol you put in your vehicle, every LPG cylinder in your kitchen, every piece of plastic, every flight ticket, every delivery cost, every factory running cost has crude oil somewhere in the chain. When crude spikes like this, India's entire import bill explodes. India spent $174.9 billion on crude oil and petroleum products in the financial year 2025 to 2026 alone. That is 22% of every rupee we spent on imports. Now, here is where gold enters the picture. India's second largest import after crude oil is gold. In the same financial year, India imported gold worth $72 billion. That is a 24% jump from the previous year. $72 billion in gold imports, second only to China in the entire world. So put those two together. Crude oil at $174.9 billion. Gold at $72 billion. Together, that is nearly $250 billion going out of India every single year for just two commodities. And both are paid for in US dollars. Now, here is the part that makes this a genuine crisis and not just an inconvenience. India's foreign exchange reserves stood at $728 billion in February 2026. By May 1st, they had fallen to $690 billion. That is a drop of nearly $38 billion in 10 weeks. The IMF has projected that India's current account deficit will widen to $84.5 billion in 2026. A current account deficit means more money going out of India than coming in. And here is the rupee maths that makes all of this personal for you. When the rupee is at 80 to a dollar, 1 troy ounce of gold at $4,600 costs you 3.68 lakh rupees. When the rupee falls to 95 to a dollar, that same ounce of gold costs 4.37 lakh rupees. The gold price did not move in international markets, but the same gold costs you 69,000 rupees more simply because the rupee weakened. And the rupee weakened partly because of gold imports. It is a self-reinforcing trap. This is why Modi specifically named gold. Not because gold is evil, not because your jewelry does not matter, but because of the three things India imports at massive scale. Oil and fertilizers are not optional. You cannot tell farmers to stop using fertilizers. You cannot tell industries to stop using fuel. But gold jewelry, at least some portion of it, is discretionary. It is the one lever where individual choices can actually have a collective national impact. That is the economic argument. Now, let me give you my honest opinion on whether it holds. Part 2. My honest opinion on Modi's appeal. I want to be straightforward with you here because I think most commentary on this has been either blindly supportive or reflexively political. Modi is right about the economics. The numbers are not invented. India's forex reserves are genuinely under pressure. Gold imports genuinely drain dollars from India's reserves. The rupee genuinely weakens partly because of those outflows. The appeal to reduce non essential gold purchases is economically coherent and not irrational. But here is what nobody is being honest about. Telling India not to buy gold jewelry is a bit like telling India not to celebrate Diwali. It is technically correct advice. It will not work at scale. India has 10 to 12 million weddings every year. Gold at a wedding is not a financial decision. It is a cultural commitment, a family obligation, a signal of a daughter's security, a transfer of wealth across generations, a religious ritual, a social contract. Prithviraj Kothari, the president of India Bullion and Jewellers Association, said it directly. India's gold demand for weddings is pre-committed and culturally non-negotiable. Akshaya Tritiya, Dantaras. Wedding season buying will not simply stop on a PM's appeal. So the honest answer is this. The appeal will have a psychological effect, not a structural one. It may nudge some discretionary buyers at the margins. It may shift some demand from heavy jewelry to lighter pieces or to digital formats. But it will not fundamentally change India's gold import trajectory. What it does do is signal that the Indian government is genuinely worried about the external situation. When a prime minister makes a public appeal like this, the underlying concern is real, even if the lever he is pulling will not fully move the machine. The government has not declared an economic emergency, but this is not normal either. And that brings me to you. Part 3. What you as a common person should actually do right now. Let me separate this into 3 things. What to think about your existing gold, what to do if you were planning to buy gold, and where to put money that is sitting idle or being saved up. First, your existing gold. If you have gold jewelry at home, do not panic. The appeal is not a tax on existing gold. It is not a seizure or a policy change. Your jewelry is yours. Its value has actually gone up significantly. Gold prices in India are at record highs of around 1.54 lakh rupees per 10 grams right now. If you have gold, you are sitting on an asset that has appreciated dramatically. Do not make the mistake of selling it in panic. And do not make the mistake of thinking that because Modi said, do not buy gold, gold is somehow a bad investment. These are 2 different things. The appeal is about import pressure on the economy, not about whether gold has value. Second, if you were planning to buy gold jewelry in the near term, this is where I want to be direct with you. The financial case for buying gold jewelry was always weak, independent of what Modi said or did not say. Here is why. When you buy gold jewelry, you pay a making charge of typically 10 to 25% of the gold value. That making charge is gone the moment you walk out of the shop. It does not come back. When you sell that jewelry, you get the gold value only. The making charge you paid is permanently lost. Second, jewelry sitting at home generates zero income. It does not pay you rent. It does not pay dividends. It does not compound. It just sits there in a locker that costs you money every year. Third, there are now much better ways to have gold in your financial life that do not drain India's forex reserves, do not have making charges, and actually earn you a return. Which brings me to the most important part. Third, where to put money if gold is in your plan. The single best substitute for physical gold as a long term store of value in India right now is the sovereign gold bond. Let me explain what it actually does. A sovereign gold bond is issued by the Reserve Bank of India on behalf of the Government of India. It is denominated in grams of gold. Its value rises and falls with the international gold price. If gold goes up 15%, your SGB goes up 15%, you get all the price appreciation of gold. But here is what physical gold does not give you. An SGB also pays you 2.5% annual interest, paid every 6 months on top of the gold price appreciation. So you're getting gold returns plus interest income. And here is the tax part that changes the entire calculation. If you hold an SGB to its maturity of 8 years, the capital gains are completely tax-free, 0% tax on the entire price appreciation. Physical gold sold after 24 months is taxed at 20% with indexation. Jewelry is subject to capital gains tax when sold. But SGBs held to maturity, zero tax. Now, there is one important thing to know for 2026. The government stopped issuing new SGB tranches after March 2026. So you cannot buy fresh SGBs directly from the RBI anymore. But you can still buy existing SGBs through the secondary market on NSE and BSE using your demat account. Some of them trade at a discount to the underlying gold value, which means informed buyers can actually get an alpha opportunity here. If you do not have a demat account or you want to invest smaller amounts more flexibly, the next best option is a gold ETF. Gold ETFs are regulated by SEBI, held in demat form, track the gold price in real time, and can be bought and sold anytime during market hours. No making charges, no locker costs, no purity concerns, no storage worry. The downside versus SGBs is there is no additional interest income and the capital gains are taxable, but they are the cleanest liquid option for most investors. The option I would be most cautious about is digital gold on apps like Paytm or PhonePe. Digital gold is not SEBI regulated. There are storage charges after a few years. The buy-sell spreads can erode returns. It is fine for very small amounts as a starting point, but not the right vehicle for meaningful gold investment. And one more thing that nobody is mentioning in all this conversation about Modi's appeal. Indian households hold an estimated 35,000 tons of gold lying idle in homes and lockers. That is 35,000 tons generating zero income, paying locker fees, sitting outside the formal economy. The government launched the gold monetization scheme years ago to try to bring this idle gold into circulation. It largely failed because Indians do not want to give up possession of their gold. But here is the personal finance question worth sitting with. If you have gold in a locker that you have not touched in 10 years, that you do not plan to sell, that is not being passed down to anyone yet, that is costing you locker fees every year, and that is generating zero income, what exactly is it doing for your financial life? The gold price has gone up, and that is real. But gold in a locker at 1.54 lakh per 10 grams held for another 10 years versus that same gold value invested in an SGB earning 2.5% annually and appreciating with the gold price with zero tax at maturity is a very different financial outcome. I am not saying sell your mother's jewelry. I am saying think carefully about the gold you are buying fresh going forward and whether jewelry is actually the right format for your financial goals. Part 4, what this situation tells us about India's financial moment. Let me zoom out for one final thought because I think this story is bigger than just gold. What Modi's appeal reveals is that India is entering a period of real economic pressure that most middle-class households have not experienced at this scale since the 2013 rupee crisis or the COVID shock of 2020. Rising crude prices, a weakening rupee, a widening current account deficit, falling forex reserves, all happening simultaneously. In these conditions, individual financial decisions actually matter more than they usually do. Not because any one family can save India's forex reserves, but because the decisions you make about spending, saving, and investing in the next 12 to 18 months will determine your own financial position when the other side of this crisis arrives. The families who come out of this period in stronger financial shape will be the ones who resisted the temptation of discretionary spending when the economic pressure was highest, who redirected money from depreciating assets into income-generating ones, and who understood that economic turbulence creates opportunities for informed investors even as it hurts the unprepared. Gold prices at 1.54 lakh per 10 grams right now. If you buy jewelry at this price, you are buying at the peak of a crisis-driven rally, paying making charges on top and putting that money into an asset that generates no income. If instead you put that same money into a gold ETF or a secondary market SGB, you get the same gold price exposure, zero making charges, and either interest income or immediate liquidity. This is not about listening to Modi or not listening to Modi. It is about understanding why he said what he said and making the financial decision that is right for you, your family, and your long-term wealth. That is the honest truth nobody else is telling you today. Drop a comment below. Are you planning to buy gold jewelry in the next year or are you rethinking it after what happened this week? I want to know what real Indians are thinking. I read every comment. Subscribe to Shivani Talks Money for more real finance content every week. And if you want to understand what the Iran war is actually doing to your money beyond just gold, watch my next video right here. It covers the full picture of what this crisis means for every Indian household.